What happens if there's a yield inversion, right? Is it impending economic slowdown like in the past? Is it a dilemma for the Fed, or should they ignore it?
I think it is a dilemma. I've heard the view that you won't get a inversion of the curve or a flattening of the curve because the Fed wouldn't allow it, because they would see it and thus be afraid. But that's not our view of how the Fed thinks. We think the Fed is trying to accomplish monetary policy, and that always in the past when we've had that inversion, there's been some reason for it. There's been some way to explain it away, and I think you could see that happen again. So, I mean, I think we would interpret that inversion as certainly a troubling sign, a sign that the bond market is skeptical that the Fed can continue on the type of rate hike path that they expect. And I think it would also fit with our view that I think this is a bull market with pretty limited runway. We don't think it's been materially extended by tax policy or technology or other factors.
Do you agree with that, Ali, overall, that actually the market is pretty much where it should be?
I think we were discussing, Andrew, before we came on, that I think the market's in an interesting place with the Fed, indeed with central bank guidance in general, because forward guidance and central bankers, broadly speaking, all agreeing that they'll respond to data as it comes in, has perversely introduced more uncertainty rather than the reverse. My view is that the Fed set its course of its direction of travel 18 months ago. Yeah. In the absence of some radical change in underlying data, you'd think they're probably about halfway through the tightening cycle. Yeah. And if they just stuck to that and didn't allow us to fret over each new set of data, I think people in the real economy, as well as people in financial markets, would have a greater sense of stability and confidence than where we were. I mean, the Fed, perhaps not quite so much as the Bank of England governor recently has been, have established a situation where they've given themselves the option of changing their mind if data changes very much. But broadly speaking, what is happening? I mean, the economy is doing well, wages are starting to rise, they're approaching full employment. They know that it's important to get rates up so they have ammunition to respond, as and when that's necessary, which of course it inevitably will be sooner or later. Broadly speaking, I think I don't see any strong reason to disagree with consensus.